Hi everyone, Ryan Dins here at New Money Investor. We just did a bit of a role reversal here today. I'm with my colleague Greg Canavan, but I wanted to pick Greg's brain on the gold situation in the gold market right now. There's been a bit of action in the gold price, and a few editors at work. Greg's been talking about gold a lot in his advisory service. Another one of our colleagues, Murray Dawes, has been putting up some interesting charts on the gold price, and we seem to have breached a key level that he was watching. And I've had a few trades in my small cap trading service in junior gold miners go out as well. So it's fairly rare that three different editors notice an opportunity at the same time in a specific market being gold. So I thought it'd be good to do a bit of a switch in roles here today, and I can ask Greg some questions on the gold market. So, Greg, how's things up in Wollongong?
Very well, thanks, Ryan. And I should point out this role reversal that we were setting up to do this interview, and I turned up to it late because my watch stopped, and it's just funny that we've come together to talk gold. You're the Bitcoin guy, on the gold guy, and my watch.
It's quite an apt coincidence, of a stopped watch and then talking about another relic, which is gold. So an interesting coincidence, one might say. So look, hopefully I've given the preamble. Like there's stuff happening in the gold price. We've all seen that. You've got this economic backdrop right now. This big picture macro environment of inflation and what's happening with interest rates, and traditionally gold has been seen as an inflation hedge, so that to some extent might explain some of the price moves in gold. But I was reading some of your work recently in your advisory service where you talked about this deeper idea that's happening at the high economic level of something called financial repression, and how the central banks and governments in the world are trying to find a way out of this debt trap they've created for themselves. So I was just wondering if you could sort of give us some insights into what this financial repression idea is and how gold relates to that.
Yeah, sure. So to put in the context of the discussions that we've had at New Money Investor and going back to some of our earlier stuff, we've made the comment that the financial system broke in 2008 and it hasn't really recovered. And what it's needed on a constant basis since then is more stimulus, more debt, and more debt to prop things up. And we've got to a point now where the debt levels across the world's largest economies is so big that what's known as the marginal productivity of that debt just continues to fall. So for every additional dollar that goes into the economy, there's less and less of an economic output and return on that debt. So the only way to really lower the burden of that debt and try and get out of a debt trap is to run long-term negative real interest rates. So a real interest rate is just the nominal rate minus the rate of inflation. And what we're seeing now post all the COVID stimulus is that governments have realized that the way to create inflation is to do it via fiscal policy. So for many years post the 2008 crisis, we thought the way to do that is via QE and central banks. Now, nearly 10 or more than 10 years of that has demonstrated that money just stays in the financial system. It gets locked up in the financial system and it creates asset price inflation, but it does nothing for the real economy. So whether by accident or design, when the COVID shutdowns happened and governments went crazy on fiscal stimulus, combined with quite clearly some supply chain constraints to getting the amount of supply into the market, it's creating breakouts, huge levels of inflation that we haven't seen in 20 or 30 years all around the world. So now all of a sudden, when you look at the nominal rate of interest minus these increasing inflation rates, you're getting deeply negative real interest rates around the world. And I think that's finally dawned on the gold market. And everyone will say, gold is leveraged to higher inflation. That's true to a certain extent, but it depends on where the level of interest rates are. If interest rates are higher than the rate of inflation, then you're going to have positive real rates, and that's going to be very negative for gold. But if you can keep bond rates below the rate of inflation, then effectively that's negative real rates. that's exactly what governments, I think, want to achieve over the next, I'm not talking the next 3 or 4 years, I'm talking over the next 10, 20, 30 years in order to try to lower those debt burdens. So I think this is going to be a very good environment for gold, having prolonged negative real rates. And the work that I've just put out for my advisory, I did a bit of research and a bit of background. And the last age of this, it was called the age of repression, repressing interest rates and holding interest rates below the rate of inflation, was from 1945 all the way through to the 1980s. And the design of that was to lower the burden from the huge debt that was incurred following World War II. Now, a lot of the benefits of that were seen immediately after World War II, so from 1945, 46, 47, where you had deeply negative real interest rates because the rate of inflation spiked following the peace. But then, as you went into, you had the Korean War, you had the Vietnam War, and lots of regulations. And I guess one of the interesting things about this period was that it was just an age of regulatory oversight. And one of the other characteristics was that the central banks took a back seat to government treasuries. So the treasury departments were in charge, and central banks took a back seat. So in the 1980s and 90s, a lot of these regulations were wound back. And, we often hear about deregulation and liberalization of financial markets, and that created a massive boom for stock markets. But there was a couple of periods in this long age of repression from post-World War II that were terrible for equity markets. And things like gold, and perhaps, we're talking Bitcoin now as well, will do a lot better in this type of environment, purely because of the likelihood that we're going to get a long period of negative real interest rates in order to try to get out of the debt burden. So we've talked about, how does this situation resolve itself? And we've talked about how cryptos and Bitcoin is one avenue where money is escaping the traditional financial system and moving into this new financial system. Mm-hmm. But on the other side of the coin, the old financial system is just not going to pack up and die and go away. The governments are going to try to prolong it as long as they can and do whatever's necessary to keep the system going. And I think one of their key strategies is to create this repressionary environment where negative real interest rates persist and reduce the burden of the debt.
It's a really interesting analogy, actually, because when you think about it, in the post-World War II environment, you had the exact same scenarios as we're talking about today, with huge debt loads, over-indebted countries, massive supply constraints back then, mainly due to decimated Europe, and all supply chains were completely locked up. So it's very analogous to today, albeit different circumstances. And I wonder, though, how it seems like you're saying, if we're going to move from monetary policy with the central bankers in charge to treasury and government in charge, I wonder how much harder that is to do in today's world than it was maybe post-World War II in a digital economy. It sounds like if they want to have this financial repression strategy, then they really have to tightly manage inflation. And, to some extent, interest rates will be allowed to float a little bit, but at the same time, they'll probably try and manage that as well. Because if they're trying to have inflation, they can't have it too far above interest rates. Otherwise, that will cause huge problems. Yep. And they obviously don't want it lower than interest rates, because then the debt burden will keep on going up. So if that is their objective, to inflate away the debt in a managed way over the next decade or so, I wonder how hard that will be for them to do in a digital economy. And I wonder, maybe, even we've talked about central bank digital currencies, you can see where they fit into their idea. If that is their strategy, you can see why having a central bank digital currency, which allows them to have micro control over the most mundane aspects of people's spending or companies' spending, then you can see how it all fits in. So it's a really good analogy, I think, if you're trying to think, well, what are they trying to achieve, and how are we going to get out of this debt trap that a lot of people are talking about?
Yeah, I think, one of the things talking about that analogy, back then we didn't have, like, everyone thinks the 70s is the high inflation, and it was, but there was some huge supply shocks in terms of the energy situation that created that really high inflation. Before then, there was just periods of a little bit of inflation, then it went down, then it went up again. Right. So and when you're in a debt trap, and which is the global economy now, it's not easy to produce inflation. Like my view is that a lot of this inflation we're seeing is just almost a perfect storm of excess demand from huge fiscal policy, as well as supply chain disruption from, the whole COVID stuff. So whether that's sustainable or not is another question. And I think, I can see periods in the years ahead where you get a deflationary sort of slowdown or even a recession, which causes inflation to disappear. And then central banks and governments say, okay, what have we got to do to get it back up again? You're going to see a whole bunch of this stuff happening. So this is not really, these inflation rates that we've seen in the past couple of weeks, double digits in some cases, which is unheard of for decades. I don't think that's necessarily sustainable. I think we're going to see them go back down. But where the sweet spot would be for governments would be to see inflation running at 3 or 4% for a long time, holding bond yields at like 1.5% or 2%, and that way you're just chipping away at the debt. So it need not be a really dangerous or a lot of tumult or volatility in financial markets to achieve this stuff. It can just be done. And I'm not saying they're going to do it successfully. There will be times where it looks like they're out of control and it looks like they're not being able to manage the inflation situation. But if you throw in other considerations like, we're trying to transition to a green economy, right? So there's no investment gone into older forms of energy, which, like it or not, the global economy still relies on hugely to power itself. So those energy prices are going to continue to rise. So in a way, you're going to see price rises still coming through, and that's going to feed into the inflationary argument for years to come as well.
That's interesting. Yeah. So like you're saying, you'll probably get these inflationary spikes, but they might be temporary in nature due either to COVID supply issues that will be resolved. Maybe some energy spikes that happen from time to time, but then are offset later on by, for instance, fracking oil can come on a lot faster than, traditional oil. So there might be reserves of oil, or even OPEC might come to it. So you might get this inflation thing, which they try and manage, which sometimes will look chaotic, and other times it will look managed. But if they do achieve their goals, then like you said, you wouldn't imagine interest rates would spike too much higher. You're not going to get this panic spike in interest rates. And if they do manage to control inflation within that band, thinking about this from an investing point of view, all right, let's start with equities. Let's say we get a decade of this financial repression. How do equity markets, how will they react to that? 10 years of negative real yields, where this inflation is a bit wobbly, but it is staying in that 4 or 5% range, or 3 or 4% range, and interest rates are staying fairly low, which is usually good for equities. How do you reckon they'll go in a decade if that is how it plays out?
In general, they should do reasonably well. I guess the question is, back in the 40s, equities were, incredibly cheap to start off with. So they responded very well to negative real interest rates and did very well throughout that period up until, I think the late 60s. There was almost a blow off top bull market in the late 60s. But now, you're going from a completely different level where really large tech stocks, for example, are just at incredible valuation. So I think if you focus your investment strategy on well-priced stocks or individual stocks with good growth runways and things like that, you can probably do well. But my feeling is if you're just putting your money into an index fund and hoping that replicates the performance of the last 10 years or whatever, I think you're going to be really struggling. So I guess the general answer is, in a negative real interest rate environment, equities and asset prices should do well. But it often depends on what your starting point is. And when your starting point is effectively historic highs in valuations, then it does make it pretty difficult.
I would say you'd want to have some sort of growth aspects to the companies you're investing in as well, because if you're a steady, 2% yield dividend play with no growth prospects, then you are essentially a negative yielding.
Well, that's where inflation eats away at you.
Yeah. So I would say, from my perspective, I know in the 60s there was the rise of the microchip stocks, the original.
Well, that was the first tech bubble, really. It was the Nifty 50 and all that stuff, and they went to incredible highs.
They went incredible highs. Then had a collapse like tech bubbles tend to do. But it was the sort of first tech bubble. But it suggests to me that in the broader context then of sustained real negative yields, you're talking about the slow death of money, which is something that we've talked about here as well. So, so that brings forward alternative forms of money, which we want to talk about today, would be gold then. So equities, we could sort of characterize that as stock pickers market to a larger extent, where you want to look for, definitely probably companies with some growth prospects. It doesn't need to be, high risk, high tech stuff, but companies that have got a growth rate, even if it's just population growth, but some growth rate above and beyond the rate of inflation, and some sustainable cash generation on top of that as well. But then you come to, all right, gold then. So if we're getting the slow death of cash, gold, you would imagine, does pretty well in that environment, because negative real yields on bank deposits actually means gold earning 0% is more attractive in some ways. Would that be the right way of
absolutely. I mean, that's pretty much the rationale for it. The other point to note is that, in the past 10 years, gold's done nothing. So it's not as if you're investing off a high base. It had a really strong rally into 2011, peaked at about $1,900, just a little bit over. And, here we are 10 years later and the gold price is at 1860.
That's the starting point argument again. So equities, the starting point is different, but gold, the starting point is
exactly.
Different.
And if you just look at a chart, gold relative to equities or the S&P 500, gold is incredibly, whether you'd say cheap or not, but it's incredibly low relative to where it's been before. So it's all about these relative valuation arguments and what your starting points are. And I think from that perspective, that's why we're having this chat about the recent move that we saw in gold over the past week or so. And it's broken out from this really long consolidation period where it did move to all-time highs back in August last year. And that was on the back of, all the spending from COVID, and everyone thought it was going to be an inflationary breakout, which is true. It's just taken quite a while to come through the system. So for the past 12 months, maybe even longer, probably, since August 2020, gold has been consolidating and moving downwards. So it's broken out of that consolidation range, and that's what's got everyone talking about gold recently. And I think, the reasons for that, of what we just described, is that, there is inflation, but more importantly, there's negative real interest rates. And if central banks can manage to hold, or if regulations from Treasury can manage to hold those bond yields below that rate of inflation, then gold is going to continue to do well.
And don't forget, central banks hold a lot of gold as well. So for them, if they can simultaneously deflate away their fiat debt while growing the real value of their gold holdings, that helps them, get their debt more under control relative to GDP faster. So there's vested interests in central banks and governments, at least not slowing down any rise in the gold price, which you might have argued they have done in the past. In some
well, I was going to say it's an interesting point, and it brings up a question I've got for you. So back in that post-1945 period, gold was very restricted in its ability to be traded, and it was mostly traded between central banks. And even that blew up in the London gold pool experiment in the late 1960s. And, effectively from then, gold went on to, that historic bull run. So it's very hard to keep price controls beyond a certain period of time. But one of the regulations that was highlighted in a research paper that I was reading in writing this report mentioned specifically that there was regulations around gold. And it got me thinking, does that mean that the newest form of gold, digital currency, digital gold, which is Bitcoin, do you think that will come into the crosshairs of the regulators more in such an environment, purely because it is such an obvious signal of what's going on with money and what's wrong with government policy and all that sort of stuff? So it makes me think that that's a risk that people need to be aware of, the regulatory risk around controlling the trading of Bitcoin, the ownership of Bitcoin, all that sort of stuff.
Yeah, look, I think you're right to point out the regulatory risk has always been something to be aware of in Bitcoin investing. Like when I first got into it in 2013, it was $600 a Bitcoin. There was a 2.5 year bear market, and I just couldn't actually think, how is Bitcoin going to be adopted? It's just going to be squashed before it ever comes big enough. But since that time, it went from $600 up to $60,000. And you're talking about starting points before, like Bitcoin is still a minute, it's a $1 trillion asset, but that's minute compared to debt markets or equity markets or even gold markets. So starting point risk reward for me says Bitcoin is still very cheap for what it offers, which is a decentralized way of exiting the existing financial system. Now, your question would be, and this has always been a criticism, regulators will come in and stop it. They have been trying to do that in various ways and forms, including Chinese governments, American regulators, European regulators. And to date, they've never found a a way to do that because of the very nature of how this thing was designed. It was designed to be decentralized. It was designed to be censorship resistant to a very large degree. So I think in my opinion at least, what we're more likely to see with Bitcoin over the next decade in such an environment is like more of a 1970s. They'll let Bitcoin off the leash. It'll let it run, and it will probably run a lot higher and become worth a lot more. In that time period, I think central banks and bigger institutions will buy up Bitcoin at various price levels and suck in more of it. And I don't want this to happen, but it probably will happen to some degree, where it'll be formed, big investment houses like Schwab and UBS and all that will own ETFs that own a lot of Bitcoin, and funds will own it in some way, and that'll happen at higher and higher price points. For Bitcoin to succeed and combat that long term, you need enough people involved in the ecosystem to hold Bitcoin regardless of that and not let it become a captured asset. To date, though, remember, you have got 18 million Bitcoin out in the wild before this was on the radars of many regulators or many major investment houses, and there's only 3 million Bitcoin left to come out. So people will buy and sell, but usually what happens is people will only sell at higher price points. So some people will only exit if we hit, say, $250,000 per Bitcoin or $500,000 a Bitcoin or $1 million per Bitcoin. And if the bigger players want in, they might have to pay up to get there. So I think from that angle, there will be some regulatory capture or some capture from the existing financial system, but I think they've left it too late to capture it in any meaningful way. And you've always got to remember, at the base layer of the technology, that's designed to be decentralized, and to date, that's the way it has worked. Anyone can become a miner with enough capital. Anyone can run a node. I can run a node from my computer, and that can verify independently. Anyone can buy, hold, and self-custody their own Bitcoin. These are all really powerful things, which I don't think regulators will be able to take over that at the moment. And for now, because it's such a low value compared to other markets, I don't think they'll be too concerned with it. I think they'll let it run wild for a bit. And like I said, they'll probably buy in over time and do like they did with gold and have a holding of it later on. That's my...
Well, speaking of gold, and to go back to another historical analogy, so back in the late 20s, early 30s, gold was effectively money. People could, transact with it, all that sort of stuff. Then gold was confiscated, and for effectively until the early 1970s, you couldn't really. I think it was illegal to own gold and to have gold in your personal ownership. It was fine for central banks and gold, in the banking system. That's where it all congregated to. And effectively, the authorities centralized the ownership of gold, took it out of the hands of the people, and put it into the banking system. So. And I'm sure that would have come as a massive shock to people who had lived and grown up with gold as money.
Yeah.
So to what extent as Bitcoin gets higher and higher and, hits all these sort of milestones, and one thing that I've noticed with Bitcoin, listening to a lot of podcasts and stuff, is how well it has educated the younger population on the issues of our monetary system, right? So many kids who probably think gold, whatever, I've got no idea what that's all about, actually are looking into Bitcoin and understanding the exact same issues that gold would have taught them about.
Correct.
And I just wonder whether, as that gets higher, governments think, hang on, more and more people are cottoning on to what we're doing, which is effectively, theft through inflation and trying to devalue our own currency and devalue everyone's work that, earns in fiat currency. We need to stop this. And what stops governments all of a sudden saying, if you own Bitcoin, you are now a criminal?
Yeah. Okay. So this is the difference between the gold and Bitcoin as functions. Is Bitcoin is not just a store of wealth; it's also a technology platform as well. So right now, to date, things are being built on the Bitcoin blockchain that are secured by the Bitcoin miners and all the other ecosystem. But it's technologies that allow, let's say the Lightning Network allows people to do remittances from America.
But that's not illegal to do so at the moment, is it?
It's not illegal to do so, but if you say it's illegal, then it's like making the internet illegal because you don't like various aspects of it. Would a country consider doing it? Maybe they would. I don't know, but can you imagine a liberal democracy like America or Europe cutting off the internet? It's just not viable. And to be honest with you, what you were saying before about young kids knowing this, it's the boat's too late for that. People decry millennials as investing all of these meme stocks and that, but they actually are big listeners of podcasts. They're big they've taken a lot of information about the financial system, and they know a hell of a lot more about the financial system than I ever did in my 20s. And I worked in the financial services industry. Until I got into Bitcoin, I didn't really understand a lot of the underlying mechanisms of the financial system. So I think in a way, if you imagine there's these people at the top of the tree that are going to try and stop this, I think the boat has gone for that, because a lot of people at the top of the tree now are not thinking like that anymore. There's politicians in America saying, how are we going to adopt Bitcoin? There's Miami coin just got launched recently in Miami, which is built on Bitcoin, essentially. New York coin just launched this week, which is built on Bitcoin. These things are actually built on Bitcoin. A really good example of this would be is the new mayor of New York, who Eric Adams, his name is, who just got voted in, or is mayor-elect, I think. So he's going to be in soon. One of his first rules is he wants to turn New York into a Bitcoin and cryptocurrency hub. And this is a huge 180 shift. New York was really hard place to do business for Bitcoin and crypto companies, because they had the established financial institutions that they didn't want crypto in there. So they made it really hard. You had to get this thing called a bit license, which no one could get. And so if you look at a lot of websites in crypto, they're like not available to residents of New York. So Binance America was allowed to everyone in America except for New York. If you think about New York, the financial hub of the world wasn't getting into crypto, and they've suffered from it. States like Wyoming have taken a lot of industry. Miami's now become the place for Bitcoin companies to set up. There's a conference there right now with Max Kaiser. And people are going to Miami and even El Salvador, even countries are taking some business. So it's already happening where there's enough people who you might have considered as part of that elite spectrum have changed and said, look, this thing's not stopping. We're going to get on board with it. And I think the point where there's a group of people saying, well, we have to stop this, I think that's gone. I think what they'll be thinking of themselves now is, how do we benefit from it? Either personally or my state or my city or my country.
No further questions.
Got out of that one.
That's fair enough. And I guess that is, I've heard that mentioned plenty of times before. If you were going to ban it, you should have done it a couple of years ago, or longer. Yeah.
You missed the boat. You would have had to ban it, I think, in 2015, 16, when I was first into it, when it looked like they could, because there wasn't enough traction with the general populace. There wasn't enough traction in the venture capital world or the financial circles or politicians. There was hardly any politicians who were into it. You could have. It's for drugs. We're gonna cancel it.
Yeah,
they missed the boat on that. So
I think, having followed gold so long and read up about its history, it tends to be the instrument that is always under the watchful eye of the government and the regulators, because it is the signal, and it's the signal for their poor policy and inflation and all those sorts of things. So it was interesting to see whether Bitcoin would then take that mantle now.
Well, to take a step back, I wouldn't say they won't try to do some things with it. What those things are and how they'll work, we'll see. But I just know that the defense capabilities of Bitcoin and crypto to stop them going too far are there, and they work. And so I just don't see I think the argument of they will ban it, I think that's gone. Will they try and control it in some way or alter it? Maybe. And you have to keep a watchful eye on it. But if you're on Twitter and you follow any Bitcoiners, you've got you've got some of the brightest minds in law even scrutinizing every word that Gary Gensler, the head of the SEC, says. You've got people trolling him. You've got people raising money, Americans raising money to donate to states that are Bitcoin friendly now. You've got this whole ecosystem of people scrutinizing these people at a level that was never possible. This is what I was saying before, in the digital economy, that was never possible in the 40s or 50s. You've got people scrutinizing the people that would have previously been making deals behind closed doors that are getting, that have to weigh up the career and personal risk. I say personal in terms of their standing in the community. Yep. Of trying to do something shifty, because you've got all these eyes on them. So I don't see it happening, but I am aware of, will there be some regulatory oversight or some way of trying to capture into the system? Yeah, there will be, but I don't think that slows down the juggernaut. It might just add some issues to think about,
Yep.
So I think the thing that I want to finish on, coming back to gold, was I think that the broader takeaway for me from this whole discussion is that it seems that the opportunities as an investor are definitely looking at adding more gold to a portfolio. Now, gold is only ever part of a portfolio. You're never going to have it as a major part. It's more of a defensive play. But if our thesis of money slowly dying continues to play out over the next decade, and if the powers that be successfully pull off their financial repression strategy of inflation above the nominal interest rates for any period of time, then it suggests to me that if, as an investor, you need to find ways to combat that. And so gold, increasing your gold allocation would be one way. Bitcoin would obviously be another way that I would suggest. And finding good growth companies would be a third way I would suggest as well. But since we're talking about gold today, I know you put out a report recently, or you've had actually a number of stocks on your portfolio in your advisory service, gold stocks. And I was wondering if you could just maybe give viewers maybe 3 stocks, gold stocks, that you think are worth looking into further as ways of getting maybe some equity exposure to gold.
Yeah, look, I mean, especially if you haven't necessarily invested in gold stocks before, I'd probably lean towards the larger end of the sector. The good thing about the gold market at the moment, we talked about, levels before of when you're investing. These gold stocks are still probably amongst the cheapest sectors going around in the market at the moment. I mean, everyone knows that there's certain pockets of extreme overvaluation. Gold is just not one of those. You can get some quality gold stocks on PEs of 12 to 13 times versus a market that's up close to 18 times at the moment. Yeah. So, with Aussie dollar gold price, it's over $2,500 an ounce at the moment. Many gold producers are producing gold at a all-in sustaining cost of $1,500 or less. In some cases, much less than that. So you're getting huge cash flow at these prices. So the threes, and I just wrote this report last week for members in anticipation of this sort of rally in gold. I said, look, if you don't have any gold exposure, here's 3 stocks that I would consider adding. And they're no surprises here. There's Northern Star, which is one of the largest in Australia. It's just a really well-run company, owns the Kalgoorlie Super Pit, merged with Saracen last year. Yep. Got some really big operations, huge cash flow generator, very strong balance sheet. So that's Northern Star. Evolution Mining is another really interesting stock at the moment. What I like about that is it's potential for a lot of growth there. It's bought a mine in Canada called Red Lake last year, and it's got a lot of investment to do there to turn that thing around. I think it bought it off Newmont, and Newmont underinvested in it for many years, and it just sort of went down in terms of its production. But there's a lot of potential there. They're investing a lot of money in it, so they can get some good growth from that in the years to come. And they've also bought operations and investing in expansion at some of their other well-established mines. So they've had quite a lot of capital to invest over the past couple of years, and I think that's taken the wind out of the sails a bit. There was a capital raising in there. But if they can turn that around and generate a good return on that invested capital, then they're very cheap at these levels. So that's Evolution. And the other one I like is Gold Road, which has got a really solid asset in Western Australia, long life. And it was commissioned last year. It's had a few little hiccups in terms of just the initial mill and processing and that sort of stuff, but they seem to be on top of those now. Share price has started to move higher lately. Really like that one as well. So there's 3 stocks just to have a look at. And if you want to take a dabble in the gold stock market, I think those 3 would stand you in good stead.
Yeah, definitely interesting ones to look at. And like you said, there's an interesting point you just made there with the all-in sustaining cost. What are they for gold? They're around about what, 1,500?
Well, that's probably on the high side for some companies.
US 1,500 or?
Oh no, well, it depends. It depends how they report it. But let's say Aussie, you're probably looking at around let's say 1,500, and you've got a $2,500 Aussie dollar gold price. So it's pretty attractive.
There's decent margins there. And if you do get a rising gold price in that environment, then that margin shifts out. And we didn't talk about the Australian dollar, but that does come off the boil a little bit recently. So if you get, in that circumstance, if you get a declining Aussie dollar, a rising gold price, and those all-in sustaining costs there, then the margins actually look pretty healthy. And like you said, a price earnings ratio of 10 to 12 becomes even cheaper. And if there's a trend going with gold. So look, they're just some ideas to look at. They're not formal recommendations as such, but they're definitely ones I'm going to have a look at. It did jog my memory when you're talking about all-in sustaining cost there as well, because I came across a tweet. You've asked me this a few times with Bitcoin miners. What are their costs of producing one Bitcoin? And I came across a tweet from a miner today actually that said the average cost right now is about $15,000 to $20,000 to mine one Bitcoin. So So right now,
decent margin
Bitcoin's
there as
about
well.
60,000. So yeah, so there's $40,000, gross profit margin on that, which is pretty immense. And that's why a lot of the Bitcoin miners we recommended recently are doing really well. And a lot of them are doing like what you're talking about with the gold miners. They're investing into even more mining equipment and trying to really take advantage of this profit margin they've got as well. So
absolutely.
All right, that was a pretty broad discussion. I think it was pretty interesting and definitely sort of laid out the big picture of money and interest rates and inflation, and sort of brought it home to where gold sits in that, where Bitcoin sits in that. And yeah, I thought that was pretty interesting. So thanks for that, Greg. Maybe we'll reverse roles again next time.
We will.
And hopefully you can get your watch wound up properly in time so we can.
Yeah, should be going. I think it's ticking along nicely.
Very good. All right, thanks. See you.
No worries. Thanks, guys.